3-1, about 3-1 on the declining advancing stocks here. We're just up fractionally on the Dow Jones Industrial Average. Just take a look at the sectors. Slightly more defensive tone, at least right at the open. REITs and consumer staples outperforming. Energy okay. Industrials flattish. Tech is slightly to the downside. People have been asking about this last two-day rally and why you're having it. I think there are a number of elements. I don't think you can assign it to any one thing, but there's obviously several things going on. I think the most important thing was simply the drastically oversold conditions, and I can show you some elements of that and why I think that is the number one factor behind the rally. We also had tax loss selling, which is now probably abating finally, and a factor in that. I think there was some limited short covering going on as well. And I think another really important point was the pension fund asset reallocation that we have been talking about. I want to show you what happened yesterday about 2:15 because two things happened at exactly the same time here. If you put up the next chart, we had a big sell program come in. Here's stocks, by the way, that are heavily shorted. I think you're going to find that there is not a dramatic change in overall short positions, but stocks that have been notably well known as shorts this week have done very well. This indicates to me that at least some shorts are being covered in the market. Maybe not the overall position, but at least some shorts. I know if you can put up the S&P versus the Treasuries yesterday. Look at this in the middle of the day. All of a sudden at 2:15, the orange line or Treasury, IEF, 7 to 10 year, dramatic sell program comes through. Somebody, groups of people selling bonds dramatically. At the same moment, dramatic buy program comes through in S&P 500. That's an allocation, folks. Somebody's out there selling bonds all of a sudden and dramatically buying stocks. And the most likely culprit there are pension fund rebalances. So you look for the fingerprints of these kinds of trades that go on in the market here. Just let me show you the VIX here. Another sign, not just of oversold condition, but over panicked conditions. The VIX was at 35 on Wednesday. The front month futures contract, which ends January 16th, was 25. The VIX is in backwardation. The cash contract dramatically higher than the front month futures contracts. That almost never happens. 35 on the VIX and 25 on the futures contract that ends in a couple of weeks. That's a sign investors panicking short term, but not so panicked going out even 2-3 weeks. They just want to get out of December. That's another sign of short-term, at least short-term bottoms in the market. As for what did well this week, it's nice to see the retailers bounce. We've seen a rather ugly sell-off in the fourth quarter here, but Kohl's, Macy's, Foot Locker, Best Buy, Ross stores all had a nice week. Gap was up 6 or 7%. Most of the retailers are up 4 to 6% on the week. Another nice group that bounced flattish today, though, are the FAANG names, and this is one of the reasons that the NASDAQ 100 had such a good week overall. So this is really nice move up. Facebook, Alphabet, Amazon, Netflix, and Apple all flattish. Again, the key thing is everybody just wants to get out of December and go back to the fundamentals, which include, of course, tariff and trade. And I'll have a lot more to say about the earnings outlook for the fourth quarter on Monday.